I'm back with a quick analysis on the S&P 500 with regards to how it reacted in FOMC. Yesterday we saw really good moves which were actually caught by our group members in the Discord server. So as you can see here, our analysis or our thesis on 17th June was stating that we are currently finding resistance on the daily order block level, which was this order block level here, because we saw price on Monday go straight into it. Tuesday was more of a lethargic day, but yesterday that was a good entry point to get your high of day. Let me just show you where the high of day yesterday was formed. Yeah, at around 10 a.m., we could see that price found it difficult to close above the daily order block level, which was 7,533.8. This was a good telltale sign as we were still awaiting the FOMC news at 9:30. Yesterday we had FOMC at 9:30 p.m. Kenyan time, which is one of the most volatile news for the dollar and equally stock indices, because it's basically an interest on it's a news on the interest rates rather, which really affects price action. So any day before FOMC we usually want to see if we can establish a bias so that we know the direction pre FOMC. If we do not figure out a good direction pre FOMC, we just negate trading FOMC and wait to see what happens post FOMC, preferably the next day, not some few minutes or hours into it. So we noted our bias as currently finding resistance on the daily order block level from a premium quadrant with a wide new week opening gap below price. Why? Because this is Friday's candle, this is Monday's candle. We could clearly see that price just gapped higher on Monday when the markets opened, and such sort of gaps in the market are usually a reference point that price more than often tends to fill. So I was really betting on this week's price action actually seeking these levels. That was yesterday. So we were biased on bearish plays to the equilibrium of the 20-day interbank price delivery algorithm data range. So let's go down to the lower time frames just to see what exactly manifested. This is the trade we were able to capture pre FOMC. That was around 9 p.m. And why exactly did we take that trade? You'd see pre FOMC there was a clean order block and break of structure, meaning that this was a good reference point to frame your execution model around. Um, and at exactly 9:30, price was within the order block. So we were using this to frame our setup. As you know, 1 to 3 risk reward ratio is our standard, because we don't really love taking on risk when the reward is insubstantial. It enables us to still be profitable even with a lower win rate. So we took this trade yesterday, mm, just some few minutes before FOMC, and as you can see, actually, it wasn't before FOMC, it was post FOMC, because FOMC manipulated higher, and most people who are news traders usually wait for news to come out and then start trading immediately on the direction that the volatility is taking price. So with my years of experience, I've seen that um, sometimes manipulation is imminent during such sort of high impact news, and I'd want to see what institutional level price is gunning for, so as to base my entry out of that. I wouldn't really trade news if price is hanging at a level that I cannot interpret. And the best level that I could have interpreted during this time is the order block, the M15 order block. So when price reached higher into it without being able to fill the gap entirely, because this is where the gap was supposed to be filled entirely. This is the lower end of the new week opening gap, which is Friday's closing price. So I was confident on executing on this trade lower based off of those facts, and I didn't want to hold the trade any in past this level rather. So you'd see once we had this reaction, this was a 1 to 4.73 R, which is a good R, especially since we're trading off the kill zone, because mostly we trade within the New York kill zone or the London kill zone. But this was New York PM session, which is not a time that we normally trade. Most of our trades are usually done by 7 p.m. latest, especially when we don't have daylight savings. So yeah, that was a good trade for S&P 500. The same thing manifested in the Nasdaq because move they more or less have a positive correlation. So whatever happens in the S&P 500 is exactly what the Nasdaq's most of the time replicates, but not all the time, right? So this was it. And why did I choose the S&P 500? Due to something called divergence. Divergence basically shows you who is the leader and who's the laggard in any specific move in price. So you'd see the Nasdaq making a higher high, meaning it had more strength, and the S&P 500 making a lower high, meaning it had less strength. So because we were betting on bearish price action, this was the better pair to trade because already it had a depleted strength. So if we were to seek lower prices, it was to give us an immediate reaction and a better move with less resistance. So yeah, that was FOMC for yesterday. Coming into today, mm, basically I have not yet established a clean bias for the day, but as we have seen, the S&P 500 and the Nasdaq and most stock indices, even the Dow Jones, which is the US 30, they've all been in a bullish trajectory. So I wouldn't really be quick to bet against the market. So I'm still looking for bullish moves because I believe price hasn't price hasn't keyed in a long term high as to which it should retrace from. So more updates on that would be going into Discord. In case there's anything else that I've left out, I'll definitely capture it in the next market analysis or commentary. um, if you're talking about the big picture perspective, let me just read to you what my comment is. And I get my big picture perspective from firstly fundamentals, and then secondly equally what the technicals are saying, but only on the monthly and the weekly time frame. So the current macroeconomic environment has shown no signs of a slow equities market. With AI inflows at maximum highs, we may still continue the bullish trend intermediate term. So we've seen price uh, key in an all-time high just this month on the indices due to the bullish move in specific stock sectors. AI holding the most bargain of this rally. So I'm not quick to call it lower because one of the most fundamental rules I usually go by when it comes to electronic trading is never try to call a high or a low. Anytime you try to call a high or a low, you might be right, but you're basically betting against the major trend. So it's a risky move to do. Yeah, so moving on to gold, starting with its macroeconomics. My big picture perspective is this: gold has been on a bullish run for over 1,000 days since June 2022. I believe a correction to equilibrium is imminent given the fact that capital is still flowing into equities and investor confidence in equities is still at all time highs, with the AI leading the narrative, of course. So, as we all know, gold is more of a safe haven when investor confidence in other assets drop because gold is the base standard for currency. It's one of the it's one of the measures of currency that has been used for quite a long time. So as I said here, since June 2022 starts, let me just look for it. Let's say November, and then we have a range from November 2022 all the way till the all-time high that was achieved just a few months ago. You'd see, no, actually, I said, oh yeah, it's okay. So you'd see the equilibrium prices around here. So I've put this pink line here as an as the 50% level. Why? Because it's better to be conservative than aggressive. I wouldn't really want to see it go all the way to the 50, but maybe a range within a range within that level, especially higher. It's rounding up to You're rounding it up just to ensure that your accuracy is on point. So currently, with the bearish price action that has been unfolding for the past 4 months, I still believe that we may be seeking lower prices. And I've been taking some trades. I took this sell just a few days ago. I was able to capture this buy as well a few last week, but one that is since then I haven't traded again because I am not quite sure where the market is going to price in the next short term high or intermediate term high before we keep on unraveling lower, if my thesis is correct, of course. So yesterday though, it had a really good reaction as well due to the FOMC that came out, and the reaction was to the new week opening gap. So both stock indices and gold had a gap that you could reference from Fridays and Mondays price action. So when FOMC came out yesterday, you can see the bearish action that unfolded. I wasn't really quite confident in trading gold yesterday because of where it was in the price range. Apologies for that. I think my screen just blacked out. Well, it was a good sell, but I couldn't really trade it because it was at equilibrium on the 20-day interbank price data range. So I couldn't trade it because I don't really trade markets that are at equilibrium, because what equilibrium basically means is that the market has already repriced, and what my strategy entails is trading for repricing. But once repricing has been done, I don't love establishing biases when the market is around equilibrium. So for gold, as of now, long term still bearish. Intermediate term, I'm still waiting for more confirmation and telltale signs that would tell us where price is moving to. um, Updates on that are equally discussed on the Discord in real time, but I'll definitely give you weekly market outlooks on Sunday again just to see what exactly Thursday and Friday have communicated. So that was it basically for this week, FOMC related, where price is at for both the stock indices and gold. Until next time, good luck and good trading.